Get ready for more valuable financial insights from Northern California's premier retirement income planners, Dan Ahmad and Jim Files, owners of Peak Financial Freedom Group. For more information, go to peakfin.com. And now, here's Dan and Jim.
Hello, this is Dan Ahmad and Jim Files with the Peak Financial Freedom Hour. We'd like to thank all of you for listening to us. Some of you, this might be the first time hearing our show. A lot of you might have been listening for years and years. And a lot of you might be current clients just trying to catch up and make sure you understand current trends and what you should be doing to make your retirement successful as we've planned. We'd like to thank everyone that has been listening to this show for a while, and make sure you know that if you have questions, needs, concerns, just dial pound 250 on your cell phone and say the keyword money, pound 250 on your cell phone and say the keyword money. You can then ask for a free consultation. They'll go through what that entails. There'll be no cost for you. You can also dial pound 250 on your cell phone and say the keyword money if you want a free copy of our most recent book called The Golden Promise. It's a very easy to read 73-page book that will teach you exactly what you need to do to create a written plan. And we think it's going to be very, very valuable. Well, Jim, today we are going to talk about a subject that I call statements you'll live to regret, meaning things you say, do, or you thought that might not be accurate in helping you have a successful retirement. So why don't you start us off, knowing that that's our title, with a key financial phrase and wisdom?
And that kind of dovetails, Dan, into this quote that was given by Mark Twain. He said, plan for the future because that is where you're going to spend the rest of your life. And when we make that statement, and when I say plan for your future, or Mark Twain says plan for your future, that's exactly what Dan and I do here. We are income planners. That's what we do. And we see people come in every day and they have statements. They have no plan. They think their statements are their plan, but they have no idea where their money is going to come from in retirement, how that's going to produce income. Will the income run out? Will the income go up or down? Will it go sideways? How do they use their assets for that income source? Is the income going to be guaranteed or not guaranteed? All those questions, Dan, they have, and they don't have answers for.
Well, the biggest fear, it's been proven in multiple studies, that retirees have is running out of money during retirement, which coincides with the same thing. How are they going to replace their paychecks to last for as long as they live so they don't run out of income during retirement? And it's our biggest fear, and yet it's not being addressed. We're one of the only firms I know of, and maybe there could be others out there. We're the only firms I know of that's our entire focus. How do we make sure our clients that we work with have a significant amount of income that's going to be guaranteed for as long as they live and never run out? And at retirement, that's what people want. And if you don't focus on that, that's going to coincide exactly with what we're talking about. If you don't focus on income during retirement and income at a high level, that won't run out, you'll probably live to regret not doing it that way. So let's just look at a quick little story. Let's say there's an engineer who helped build the Titanic, and they said even God himself could not sink the ship. Well, we're assuming that he regretted that statement at some point down the road as it did sink and many, many people died. So that's kind of just like the stock market. People say, well, it'll never go down. The market always goes up and always goes down. And if that happens, you can't take much income off of that asset. So let's talk about some of the financial statements people are probably making right now, or they've made often, and they end up coming back to bite them. So how about this one, Jim? Why don't you take this one? I told myself a few years ago after these, multiple market crashes, I'd get out of the market if I ever recovered and hit my magic number. And I know I've recovered since 2008. So I guess I should just keep doing what I'm doing.
Well, when you're younger, Dan, you can kind of have that attitude, right? If you're 30 or 40 years old and you're making contributions to your 401k plan, and your dollar cost averaging each paycheck, and the market goes down, you lose a bunch of money. Well, you can stay in it, and you can hope to get back to even, and hopefully even get better than even, because you have another 20 to 30 years to work. But when you make that statement when you're 60, it's a big different story, because if you're going to retire at 65 and you lose 40 or 50% of your money, and you want to retire in 5 years, and you say to yourself, I need to get back to even, that's where the tragedies come in, because then the client has to be aggressive at that point to get back to even. And then if the market does another downturn like it did between 2000 and 2007, where we had two 50% crashes, then all of a sudden the world changes for that person, or if he's married, that couple, because their plans for retirement have just vanished.
Well, Jim, here's a good numerical number, then maybe continue on with that. The thought process of hanging in there, writing it out, like you said, is great when you're young. So between 2000 and 2024, you had the same returns as the S&P 500 index and didn't take any income out. Okay, no income out. And let's just say you're paying 1% in total fees. $1 million would have been extremely volatile during that time period because we had the 2000 and then 2008 crashes. But if you would have hung in there, wrote it out, not taking any income out, $1 million would have grown to $4 million.
Yep.
You've succeeded.
Yep.
You've 100% succeeded. The problem is if you started taking income out, let's just say you needed $50,000 of income off your $1 million just to survive. In that same exact time period, your money would have run out in 12 years.
It's mind-blowing because we show these types of charts all the time to people that come in to seek a second opinion with our firm, and they see these numbers in black and white, and it actually blows them away. Said, how is that possible? How could I have earned $4 million over that period of time? But if I would have been retired and took $50,000 out, and during that same time period, if I'd gone through the market ups and downs, I would actually run out of money in 12 years. And the answer is yes, you would have, because people don't consider the impact of what income does as it comes out of your portfolio.
Well, Jim, that's called the double dip. It's the double dip effect in a negative occurrence to your portfolio, because if you're going through a market downturn, okay, your account goes down, but if you're not taking income, it doesn't go down as much. What happens when you lose 20% in a year and you're taking 5% out? So now you've taken 25% out.
Yep.
It's a double dip, and it's almost impossible to recover from.
Yeah, and people don't understand this. They believe that their broker tells them you can take 5% out in the form of income off your portfolio. You're never going to run out of money, and when you die, you're going to leave lots and lots of money to your grandchildren and your kids. Well, you just can't take 5% out of your portfolio with the assumption it's going to earn 5%. Yes, some years it might earn 10, 15, or 20%. Other years it's going to lose 10, 15, 20, 30, or 40, 50%. So that 5% impact you're taking off your portfolio doesn't work because it's not straight 5% in growth. It doesn't work that way.
Well, think about what some people do. I have a lot of clients that have looked at the market and they've been in it for 40 years and like, we'll just write it out. And in the good years, we'll take all of our gains. And in the bad years, we won't. Well, if that's their philosophy, then in the good years, fine, take out all your gains. But that means in the bad years, you have to replace that much money back into your portfolio to get it back to that measure. So let's say in year one, the portfolio goes up 20% on $1 million. You take out 200,000. Mm-hmm. So you still have $1 million in your account. What if the next year goes down 20%? Mm-hmm. That means you've lost 200,000. You got to put $200,000 back in there just to get back to $1 million. So how in the heck is that ever going to be a viable income plan?
It will not work. But unless the consumer sees this in math laid out for the next 20 to 25 years of life expectancy, they don't understand it. And that's the whole problem, because they think they're still in the asset accumulation stage and they should stay the course, invest for growth, and you'll just be fine. Well, that's true when you're 25 to 55, but that's not true when you enter the second phase of life, because there's two 30-year phases of life, right? You got 25 to 55 where you're working, you're accumulating assets, you're taking risk, you're taking and putting money into your portfolio to grow it. But then you have 30 years of life expectancy from 55 to 85. You better learn how to preserve those assets, because those assets are going to be used for income in the future. And you have to understand the dynamics around both of those phases, Dan.
Well, to get to what's called your magic number, a lot of people say, well, I have to continue to recover. I have to continue to get these huge rates of return. And every consumer makes up a fake magic number, because they make up an amount of money they think they have to save without knowing how much they need to save, just to make themselves feel comfortable that everything's going to be okay. You might say my magic number is $1 million. You might say 2 million. You might say 3 million. You might say 5 million. Well, how in the heck do you know that's the magic number? The magic number isn't the amount of assets you have. The magic number can only be calculated based on when you retire, how much income you're going to have after taxes every single month. That's your magic number. Of course, the amount of assets you have will create that ultimate magic income number. But so many people we talk to have no clue. They've already succeeded at 58, 60, 62, 65. They've already more than succeeded. They have more than enough saved. So in their minds, they've already exceeded their magic number without knowing it. When we do an income plan and show them they're going to have $3,000, $4,000, $5,000, $6,000 more to spend now at retirement than when they're working, it opens their eyes that they've done an awesome job saving. They just didn't know it because no one else has done a calculation.
Well, what they have to understand, Dan, as well, is that we're not just using portfolio assets. Yes, portfolio assets are part of the blend, but we're using very disciplined products, different financial instruments, different strategies to make all this work. So we're not just saying put $1 million in the stock market and earn X dollars and have excess cash flow. We're
Well,
not
we
saying
just
that.
proved that doesn't work.
It doesn't work. It doesn't work. So you have to change the game up, right? You cannot do the same thing and expect different results. You have to figure out, how do I take these assets, deploy them in the right asset classes, and how do I then generate income that will never run out? And how am I guaranteed that? How can I see that and know without question that income will be there forever?
Well, do you want your magic number income to be maybe income that could stop or be reduced at any time? Or do you want your magic number of income, meaning how much money is coming in every month for as long as you live, on a guaranteed basis? And every single person listening right now will say they want it on a guaranteed basis. No one wants it on a maybe basis, because income drives lifestyle. If your income goes down or is terminated, your lifestyle either goes down or is terminated. The whole focus is to find out how much income you can create, as long as you're not going to ever run out, and as long as you're not going to be in a high tax bracket, and then create the plan that will allow you to max out your income as long as it's going to last for as long as you, and if you're married, your spouse lives, but also do a calculation to show you won't be in a high tax bracket. Other advisors, most of the advisors out there, they're not able to do tax calculations for you because they're not accredited tax advisors. They haven't been an enrolled agent with the IRS for over 30 years. We're able to do those tax calculations because of my tax background. And that's one of the biggest fears people have about retirement. They think, oh my gosh, if I take my money out, Jim, I'm going to get killed with taxes, and it's just not going to happen. You're back with Dan Allman and Jim Files, the Peak Financial Freedom Hour. Thanks for staying with us. Today, we are talking about statements, financial statements that you've made or have or will make that you might live to regret, meaning things that just might not be true in helping you attain your goals of financial security and retirement. So the first one we covered was that you've promised yourself you'll get out of the market once you recover or once you get to your magic number. And unless that is a calculation done based on how much income you're going to have, you don't want to base your decisions on the amount of assets you have. You want to base them on the amount of income. How about this one? I like the security of keeping my money in cash because I know at least I won't lose it.
Well, that's for some of your assets. I agree with that. Some of our assets should be in cash because we don't want to lose them. But to have your money just in cash and think you're going to retire on the income off that cash is probably a false hope. You need to put money in cash for safety, for security, for liquidity. And the reason you're doing it is because you're afraid of the market. So there are other financial instruments whereby you can get the same safety, or in some cases, even more safety, but also generate maximum income.
Well, what happens right now, keeping my money in cash in the bank, et cetera, money markets, what happens as the Fed lowers interest rates? What's going to happen to those future rates for these people that have $1 million or $2 or $3 million sitting in the bank?
Well, they've already seen this in the last year and a half, right? Rates in CDs were over 5%. Then you drop to 4.5%. They're down to 4 now, a little bit less, maybe 3.8. Interest rates are beginning to drop. If the president has his wishes, or when the Fed chairman gets booted out in next May, interest rates are probably going to precipitously drop. So those CDs that were getting 5 a year and a half ago will probably be getting 2 real soon.
Well, what you were talking about earlier, the alternatives right now, current rates as of today, as far as guaranteed lifetime income payout rates, meaning based on how much money you put in, what percent of that will you get paid out for as long as you live, and if you're married, for as long as you live. Currently, we have payout rates of 7%, 8%, 9%, even 10% or higher based on your ages and when you want the income. Net of fees, it would be guaranteed to be paid out to you for as long as you live. Think about that. Can you get 7% guaranteed forever from any place? Nope. 8%? Nope. 9%? Nope. 10% or higher? Nope. I just did a plan for a couple. They're 60. They're going to retire at 65. So we don't need income until then. And they're going to get a 10.5% guaranteed payout of their money, guaranteed forever. Where can they get that? Even if the stock market crashes, it just puts them in that type of position. And if that is something you're interested in, just dial pound 250 on your cell phone and say the keyword money, pound 250 on your cell phone, say the keyword money. We can then calculate out how much you'd be able to get out guaranteed for as long as you live, which will literally completely change your life.
Retired people or soon-to-be retired people don't even know about these plans, Dan. They're not publicized, but there are these products. They've been around for hundreds of years. They do work. They're guaranteed. They're guaranteed to pay that income for you, or if you're married, for you and your spouse for as long as you live.
But they're not exciting or sexy.
No.
They're boring and safe.
They're boring and safe. And if you ran out of money, guess what? they continue to pay you for as long as you live. So how would you like to sit down right now? You're 62 years old, you're going to retire at 65. You say to yourself, if I defer that income for 3 years, I can get an 8 or 9% distribution on my money for as long as I live. Would that change the way you look at your money? Would that change the way you envision retirement? Would that change the way you're going to plan for retirement? Because now we could sit down and say, okay, with X number of assets into this category, we can get you guaranteed income of Y. Wouldn't that blow your mind?
Well, think about it. Right now, all the people, Jim, that are listening to you just say that, 90% of them do not have significant pensions or any pensions at all. And what's the one thing all 90% of those people wish they had right now?
A pension. They all do.
A big pension.
Yeah, big pension.
A big pension. Because what does a pension do? It pays you income guaranteed for as long as you live. And then if you pick the right option, it'll pay the income to your spouse for as long as your spouse lives. So when you started saving money, when you were 20, 30, 40, whenever you started saving money, your whole goal was to save as much money as you could for retirement so you could then create as much income as you could at retirement. The problem is now you have $1 million or $2 million or $3 million and you look at those dollars as your investments. They're not your investments. It's the assets are what's going to allow you to create a high level of income, and it's all you have to create a high level of income. So with those assets, should you be trying to get the most growth or the most income at retirement? And the answer is simple. It's the most income. You can take minimal, maybe even 0% risk, and then get guaranteed income at the highest level for as long as you live. That's 7%, 8%, 9%, 10% or higher payout rates on your money for as long as you live.
And wouldn't it be beautiful if you could sit down and say to yourself, okay, I have $2 million and I want to be able to generate at least $100,000 off my assets, a minimum, not including Social Security. If you have rental income or a pension, that's all extra. And you can sit down and deploy some of your assets at that high distribution rate we're talking about to get that money that you need, that $100,000 a year off your assets. The other money, you can go for growth if you want to, right? You can, because if the market goes up and down, which it will for the rest of our lives, you won't be panicked. You have enough income to do what you need to do because you're distributing a high level of income distribution off some of those assets.
Well, here's a good example. I had a gentleman come in. In fact, he's coming back in tomorrow, so I can print out his plan, give it to him. He has about $3.2 million of assets. He's single, and his brother comes with him, and his brother has 2 daughters, so that's who will be the beneficiaries, will be his nieces when he's gone. He has $3.2 million. He has no pension. He has Social Security. And right now, if the market crashes like it did in 2008, he'll lose about 53% of his money, which probably means about $1.6 million in losses. And he's 72. He doesn't want to take any risk literally at all, like 0% risk. And I said, okay, I can design 2 plans. Before he said that, I can design one that has risk that'll drop your 53% down to 5%. And he goes, well, that still means $150,000 loss. I go, yeah, because I want it 0. So I'm like, okay, I can create a plan like that. So we created a plan with no risk, meaning the market crashes anytime going forward. Once we implement his plan, he won't lose 1 penny. And as a single individual, he's going to have $22,000 a month of net after-tax income for the rest of his life. Not gross, $22,000 a month every month for as long as he lives, guaranteed. How did that, you think, now is going to make him feel?
Well, it'll change his life, because if he was to put that money in just a stock and bond portfolio, the safe withdrawal rate right now is 3%. So you take 3% of the $3.2 million, that's about $93,000 a year, right? What's the difference?
Minus taxes.
Minus taxes, right. It's killer. I mean, it's really killer.
You're back with Dan Ahmed, Jim Files, Peak Financial Freedom Hour. Thanks for staying with us. We are talking about statements that you may live to regret if you make these. Here's one of them that I get. Maybe 1 out of 8 clients that I'm working with says something like this. Nobody in my family's lived past 75, so I'm not really planning to live much longer than that. And I look across the desk, and the people look pretty good shape. They look pretty good. They look a lot younger than they actually are. And I just ask them, are you crazy? And they're like, what are you talking about? I go, are you crazy? You want to plan so that it's okay if all your money runs out by 75. And if you live past that, you don't have any more money. He goes, and usually the guys will say, yeah, because I just don't think I'll live past that. We're not going to plan that way. Even if you think that, we are not going to plan that way, because what if you live to 76, 77, or 86 or 96, and now you ran out of money? I always tease my clients and I say, I don't want you walking in here with a cane and try to beat me with your cane when you're 78 simply because you ran out of money and it was your idea. We're not going to let that happen. So we don't want you to live to regret that. We have to make sure income will last forever. And a lot of times people say that, Jim, because they think they can't generate enough income that'll last forever because they're using the bank or they're using the stock market distributions. But if we use the right plans with high payouts, can we now give them a significantly higher income that is going to be guaranteed to last for as long as they live?
Yes, we do this every single day. We can generate significantly more income than a prospect or a consumer thinks they can generate off their assets. And you can get that income guaranteed for as long as you live. And if you have a spouse, as long as you both live. The thing is, Dan, is that they haven't been told about this. They haven't been introduced to how these products work. They don't understand them. They haven't been educated. But once they do become educated, 95, 98, 99% of the people say, why wasn't I introduced to this before? And I want this in my portfolio. They all say that.
Across the board. Well, we have it in our portfolio because we would be crazy and stupid if we didn't.
That's right.
When we know, you and I know, we've already succeeded accumulating enough assets to last for as long as we live. So at this point, why in the heck would we risk a big chunk of that? For what? For the chance to fail? Well, we have an equal chance of failing as an equal chance of succeeding in the market, which we understand, risk equals return. But why would we risk so much money? I don't risk that much money. I don't want to take a big loss at this point. The issue is most people listening right now, they don't think they've succeeded because every one of our clients that become our clients, they're really good savers. Mm-hmm. They saved, and they saved more and more because they always were freaked out and worried that they didn't have enough saved, and they did without, and then they didn't go on that vacation. They didn't buy the car they wanted. They didn't do the remodel. Some, do a lot of those things, but every single person, whether they saved $1 million, $2 million, $3 million, $5 million, very few know or feel that they've saved enough. So if they haven't saved enough, it means they have to continue to save, they have to continue to work, or they have to not spend much money out of their portfolio because they don't feel like they've saved enough. And if we can then prove to them in a written comprehensive plan that shows they have saved enough because then after taking out the income, after paying the taxes, they have more money than they're going to need to spend each month, does that then satisfy the problem?
Yeah, once it's in writing, once they see it, once they're educated, they know you and I are actually signing off on these plans, right? We're not just telling people this is the way it's supposed to work. We're signing off on those plans, which is significant for an advisor to sign off on a plan.
Well, how many people have full written plans right now on average out of 1,000 people?
I've never met any. Have you?
Well, I think I've seen in 40 years, I've seen 3 people that have had a full plan, everything written out. And I told those clients, stay with your advisor. They did what we would have done, and it looks okay. Yeah. But that means 3,997 didn't have anything.
Yeah, exactly. And people, they're right now, people becoming complacent like they did back in 1999. You look at the stock market right now, Dan, it is scary. I mean, it's overinflated. It's running at a very high multiple. If you look at all the analytical tools that we look at, everything is saying the same thing. This market is overvalued. The market is so overvalued right now. The last time we saw this was during the dot-com bust in 2000 when the market was trading at the levels it's trading at today, and the market plummeted 53% over the next 3 years. Yes, they say, well, this could be different this time because it's artificial intelligence driving the market versus tech, right, back in those days. But it is tech.
That is tech.
It is tech, right? It's craziness. But the multiples are unnerving. People are throwing money at this market. They think they can never lose. But if you look at the S&P 500, Dan, over 50% of the growth on the S&P is coming from 11 stocks. So they're all tech stocks, every one of them. So ask yourself,
what if 1, 2, 3, 4, 5 don't do well or fail? What happens to the whole market?
They don't have to fail. All they have to do is their earnings have to be less than what they're projecting right now, and the market could drop 20 or 30% overnight. It could be disastrous for people getting close to retirement. Now, if you're 30 or 40, don't worry about it. You'll be fine, right? Keep on making contributions to your 401k plan. But if you're 60 or 70, it's a big deal if you make a mistake right now at this point in your life.
When you think about the people that think they won't have a long lifespan, what I've found is a lot of those people are still working or they just recently retired, and they still are either working and still stressed out about their job and they don't feel very positive about things, or they just retired and they're still a little stressed out about the job and they don't feel positive about things. Once we see people that actually have a plan in writing that shows they can generate a significant amount of income with a big chunk of it guaranteed for as long as they live, it'll never run out, and show them that they won't be at a high tax bracket, we find that is the single best way to get rid of any of the depression or the anxiety about retiring, and allows them to think, I'm going to have enough money no matter how long I live. So at that point, don't you want to maybe live a little longer?
We have met with so many people over the last many, many years. And I can't tell you, I couldn't even count how many people have told you and I, Dan, that we have changed their lives. We've actually changed their life. We've had people even cry going through this process because they're all worried about running out of money. They all are. I don't care how much money you have. You think having $2, $3, $4, $5, $6, $7 million, people don't worry about their money? They all worry about their money, right? Every single person.
I had a great client come in, one of my favorite clients, and they had over $5.5 million saved. And the gentleman who took care of the money had never told his wife how much money they had because he was so embarrassed that they didn't have enough and there's no way they were going to have a successful retirement.
Yeah.
Think about that.
Yeah.
So he didn't know he'd succeeded. We created a plan that showed them their plan's going to work. They have about $27,000 a month of net income after taxes. Their money's never going to run out. And it proved to him and proved to her that they've been unbelievably successful. So why not take advantage of that and let it drive the lifestyle that they want?
Well, people are afraid to. Number one, they don't know how to do it. Number two, they're afraid to because they think to themselves, they're always worried about, what if I make a financial mistake? What if I run out of money? What about inflation? What about long-term care? And they're afraid to spend their money. And what they do is they do nothing at all. They just sit there and listen to the radio and they do nothing at all. People have to react and do something to make a difference in their life.
You're back with Dan Ahmed, Jim Files, the Peak Financial Freedom Hour, and thanks for being with us. We're going to cover one more segment of this show, which is titled Statements You Might Live to Regret. So we covered a couple of them. The first one was, if I hit my magic number, then I'll get out of the stock market and taking so much risk. And we let you know that it's not the magic number of the amount of assets you have. It's how much income can you create off those assets. The second was, keeping all your money in cash is the safest thing to do. Well, in reality, safest thing, you won't have any risk. The problem is then as interest rates go down, your assets will be used up. And when it's used up, you get no more income. The third was, if you think you're just going to live to 75 and you're worried that your money is going to run out, so you're just planning that long, we need to plan you're going to live for a long time and make sure you have a high enough income. How about this one? I get some people saying this, and it is, I can always go back to work if I really have to. Well, let's say you're 60 and you retired. Yeah, it's probably easy in a month or 2 months to get back into that flow because you still have your connections. You can call. Maybe you can go to the company or the government you retired from and say, hey, I want my job back. But if you've been out of the game for a year, 2 years, 3 years, 4 years, you're 67, 70, etc., you're probably not going to be able to go back into that same level or same position and probably not make the same amount of money in general.
Probably. There's no way possible, right? I mean, there's no way. If you're 67 and want to go back and you're making $250,000 a year at your previous job, you're in the tech business. Hey, forget about it, folks. You got a 25-year-old coming up the pike with an MBA. You're not about to get that job. So you have to look at it from reality's perspective and say to yourself, okay, I have this amount of assets to invest. How do I do that safely so I won't run out of money? And that's how you have to do it. You have to say, how do I do that so I'll never run out of income? What if I do live to 90, 95? My grandmother lived to 103. You have to design plans that'll last till you're 100. I don't care if you think you're going to die early. You have to make sure longevity is in the plan in order for you to survive the future.
Well, here's what all of our competitors will tell you. You have to go for maximum growth to have maximum success. And the problem is they're telling the truth on half of it, but they're leaving out, not disclosing the truth on another half of it. Yeah. And the truth on the half of it is, if you're 20, 30, or 40, even 50, you can go and you should be going for the maximum growth your stomach will allow you to take, meaning with the maximum volatility, potential for maximum losses, because over the long term, 20 or 30 years, you will almost always get a higher rate of return by investing more aggressively. The issue is these types of advisors will tell you to take that same exact philosophy into retirement, and it's exactly wrong. Once you retire, you no longer can worry about maximum growth. You have to worry about maximum security and maximum income. And if you think about it for retirement, if you have maximum growth and your portfolio is going up and down all over the place, even if you make big rates of return, how much income can you really take off that? Maybe 3%, which isn't going to do you well, and you could run out. At retirement, you got to make sure you minimize or eliminate your chances of these large losses, and you create the largest amount of income, just like a pension, that's contractually guaranteed in writing to last for as long as you live and as long as your spouse lives. That is the only way you will design a plan that will give you the least amount of worries in retirement.
Yeah, but people don't know how to do that, Dan. And if you're dealing with an advisor now, I'm sure they're a really good advisor, but they likely don't know how to do it, or you wouldn't be probably listening to our show. Because to do this, you have to have that skill set. You have to have that knowledge base. You have to be skilled in this for many, many years to be able to take a portfolio and remodel it, restructure it to get you this level of income and to reduce your risk significantly. And when we do these analysis, we have people come in every day and we ask them, the first thing we ask them is, how much risk do you think you have in your portfolio? And guess what everybody says? They either shrug their shoulders and say, I don't think I have very much, or they say, I don't know, or they might say, my broker said I don't have much risk. But when we do the analysis, we're using outside third-party research companies to do the analysis on behalf of our clients. We pay for the service. Dan, typically, if a client comes in here, has $2 million invested, how much risk do they typically have?
When they're coming in here before they meet with us,
Yeah.
they're somewhere between 40 and 50% on average, almost across the board. If they're less than that, it's a minority. If it's more than that, it's a minority. It's somewhere between 40 and 50%. And none of them, not one of them, thought they were really taking that much. Even the ones that knew they're being aggressive, they might say, yeah, I could lose 20 or 25%. Then when you show them they could lose 50%, they're like, you mean if I have my $4 million and I lose 50%, I'm going to lose $2 million right now? Yeah. But think about it. What should you expect if your money's invested kind of the same way as it was in 2001 and 2 when it went down 50% and then you recovered, or the same way kind of that you invested in 2007 and 9 when it went down 50%, then you recovered? If it's invested kind of the same way, what in the heck do you expect is going to happen?
Yeah. People think it won't happen again, folks. You guys are, I don't want to say, how do I phrase this?
Complacent is the proper word.
Okay. I'll say complacent because it is going to happen again. People thought in 2001 and 2, when the market dropped 53% over that 2.5-year period, it would never, ever happen again. Well, guess what? 5 years later, in 2007, 8, and 9, the market dropped 57%. If you invested in the NASDAQ in 2000, it dropped 68%. That means it took you 19 years to get back to even if you'd stayed in the market. So it will happen. It'll happen casually.
Well, take those big ones out of there. Take those huge losses out of there. Go back to 1929. The stock market itself as a whole has gone down on average every 5 years, an average of 39%. So you should probably be looking at that as your guide to what might happen in the future, not for the gains, but for the losses. And if you're not planning that the markets are going to go down 39% every 5 years from this point forward for the rest of your life, and it does, what happens now?
Your plan's blown up. Your life is blown up because you invested incorrectly, right? You didn't understand the numbers. It's just numbers, folks. It's just history. It's just facts. You have to understand these facts in order to navigate through the rest of your life. You have to understand that if you're in your 60s or in your 70s, you better have a game changer built into your plan, which means that how do I protect myself from these types of losses in the future? How do I position my assets right now and understand how those assets are positioned and have in writing how much risk I really do have so I don't make a stupid financial mistake?
Well, and that kind of stupid financial mistake could then force you into the position of what we're talking about in this segment, and that is you having to go back to work. And if you want to go back to work just because of being around people, social, keeps your brain active, great. But if you're in a financial position that forces you to go back to work and forces you to make a huge amount of money after you've already retired, it's going to be tough.
For more information about Peak Financial Freedom Group or to schedule a consultation, just go to our website, peakfin.com. That's peakfin.com. And thanks for watching.